Good day and welcome to this masterclass on risk management. So today I want to share with you insights on what effective trading and investment is all about. And I hope that this video actually shifts the perception towards trading and investing. So stick with me as we discuss risk management. So in this video, this is what we're going to be discussing. We'll be discussing risk management, what it's all about, the magic it begets, why risk management, right? That should be a question you should be asking. Why am I talking about risk management? Or why am I bringing up topic risk management? Or why do you need to manage risk? Furthermore, we'll go further to discuss risk managing trader and investor. How does managing risk relate to a trader and investor? And then this very big saying, every trade is a loss. What does it mean? Have you blown an account before? How do you avoid doing that again? That is avoiding rock bottom. The best risk management strategy I know of. I'll be sharing that with you. So stick with me for these few minutes while we discuss risk management. Okay. Now the magic of risk management, right? These are three classic scenarios in the markets. You may have experienced this kind of things in the markets. So this is a clear example. We have a support level that the market actually traded from. You see here is the resistance broken on support, if you understand what that clearly means. And then you bought here, or you when you came to do analysis, you saw that okay, this is a strong support. The market traded off here before, right? And then the market came back to that zone. You see this is a hammer. If you understand price action properly, you know that this is more like a confirmation that there are demands or people are interested in buying from this market, which is a telltale sign for us to get into the market, right? And then subsequently, maybe you got into the market after this engulfing candle printed your stop loss below this point, and then the market went sideways, and then did this, boom, triggered your stop loss. This is a classic example of what happens in the market every day. You may have experienced this, right? So that's a first case study, a first example. And then the second example is this: we are at a resistance in the market, right? And you saw that the market have tested this resistance before and then it sold. The market came back to that same resistance again, it sold. Maybe this is you trying to sell here, stop loss above this point, and then boom, market triggered your stop loss. So yeah, then if you don't have a stop loss, for people who do not use stop losses, what could happen? Drawdown, probably margin call, and liquidation. People who do not use stop losses. And another classic example is this, where we see, okay, this is a very strong support in the market. This is where the market had this first reaction, second reaction, reacted from the zone, reacted from the zone, reacted from the zone, reacted from the zone. And then maybe the market is approaching that particular point again, you bought stop loss below the zone, and then it took you out. Before you bought here, something interesting has happened. This is descending trend line, right? And then you can see that the market has been respecting this trend line. Came here, rejected and sold off. Came here, rejected and sold off. Came again, you sold here, stop loss above this point, and then you hit TP probably. And then a second time, you sold somewhere around here. You extended your trend line. This is where you sell. You sold stop loss above this point, and then it took you out. And interestingly, and as painfully as it is, after taking you out towards the upside, market sold towards your direction. This is the case for risk management. Now, the beautiful thing about risk management is that it doesn't take away these occurrences in the market. Rather, it helps us be adequately prepared for these scenarios in the market. Take, for instance, if you are the trader that have this perception that managing risks are not your thing, or probably using stop losses are not your thing, how would you have managed? How would you have felt? How would you have felt in these situations in the market where your estimated zones have been invalidated, the market is going against your prediction? How would you have felt? This brings us to the next topic. Then we have why manage risks, right? So let's see the essence of managing risk. Yeah, I enumerated four of my risk management reasons, what I call the three C's. The three C's and 1D framework is my strategy of managing risk or my whys for managing risk. Three C's and 1D framework. And I say confidence, right? Have you ever been in the market and then you open the trade, all of a sudden you start feeling uncomfortable about that trade just because the trade is going against you for some pips or for some ticks down, you have a drawdown and you're not comfortable, you are not confident in the trade. Like, I don't know, there's this feeling you're not yourself, right? You're not confident in what you've done in the market, not just in your analysis, but in the amount you are risking in the market. You are risking way beyond you can actually bear. So risk management helps you avoid that kind of scenario in the market where you open a trade after doing your technical analysis or fundamental analysis and then you open a trade because now you're not confident in what you've done. Telltale in your risk management, you sabotage yourself by closing the trade before it plays out. I don't know if you've had that kind of experience before. You did an analysis, you open the trade, and then because you are not comfortable, you're not confident in what you've done, you close the trade and the trade went to your direction, and then subsequently you got angry, you took another trade, that one became a loss. And now maybe that gives birth to what we call revenge trading, strings of losses, and stuff like that, right? You don't want to have that experience. So, yes, it gives you confidence in the market. Now, capital preservation. Now, in those scenarios where we shared, right, these examples that we looked at before in the market, these examples that we looked at in the market before, the previous examples where you saw three case scenarios, or rather four case scenarios, the sells, the buys around resistance and support areas, that the market actually invalidated your biases of buying and your biases of selling. Let's imagine that you did not have a stop loss, per se. What would have happened? Probably margin call. But if you have a stop loss, which is your risk management, in the market, whether you are trading spot, futures, options, wherever you are trading, you have a stop loss, which is your point of invalidation in the market. Definitely your loss will be the loss you are comfortable with, right? And then it will cut the amount of loss. You will not be margin called, you will not be liquidated because you have stop losses in the market. That is for capital preservation. Now, comfort. This management gives you a different level of comfort. It gives you this confidence, it makes you comfortable with your trade, it makes you to be able to hold trade for a longer period of time. Take for instance that you open the trade and you are comfortable risking $5 on that trade. You can open the trade, set your stop losses, set your take profit, and then you forget about the trade. Maybe the only time you'll be coming back to the trade is when you discover that, oh, the trade have actually hit your profit or it have hit your stop loss. It gives you this kind of comfort. You don't have to worry. You don't have to be going through your screen. You don't have to be going through your chart. You don't have to be going through your MetaTrader, whatever you are trading with. If you are trading crypto, your exchange, if you are trading forex and CFDs, you don't have to be checking and checking and checking. You can just open your tree and go about other things you want to do. Check on your loved ones, go for school run another business, attend to other things. That is something that risk management gives you. And it's a feature of being a pro trader. Now, what about discipline? This is where many traders actually falter. If you cannot manage risk, you are not a disciplined trader. If you are not consistently managing your risks, you're not a disciplined trader. Because the equation of discipline, the equation of setting stop losses, the equation of risking a given portion of your portfolio or your capital consistently, it demands of you discipline. And without discipline, you cannot actually do fine for trading or investing. So discipline is an indispensable part of being a professional trader, and it's an indispensable part of successful risk management. Remember, Warren Buffett said something. He said, "Patience is golden, and patience takes discipline." For you to be able to practice discipline, you have to be able to wait patiently, even when you don't see your trade setups. That is also risk management. No trade is a trade in the market. So that's that about why you need to manage risk. So the next things we'll be looking at risk managing trader and investor. Yeah, that's the next thing we are looking at. Now, who is this guy that manages risk? What does he do for him? These are the things that such traders actually get to experience. One, this guy is very consistent with wins because he's managing his risks properly, which we'll be talking subsequently down the line. He's consistent with wins, which is the aspiration of every single trader in the market. You want to be consistent with your wins. Risk management helps you to do that. If this trade is not your setup, is not the kind of signals you trade, is not the pattern you trade, is not this the markup you trade in the market, you don't take it because you are in a haste to make money, or you are feeling like, oh, you need to get to the market, you feel like you're missing out. This is one of the things that risk management does for you. It keeps you away from trades that are not yours. Now, risk management makes this guy, this trader or the investor, become a pro because he have understood trading and investments. He have come to understand that less is more, right? That trading is his business and he has to manage it properly. He has to do the right things. He has to observe every single protocol, every single process that he has actually outlined that makes his trade a success. He looks for the signal. If he doesn't see it, he stay out. Look for risk consistent capital size, portfolio size, set stop losses, set take profit targets. These are the things risk management does for this guy. And these are the things that this guy does. Baby traders cannot do it. And that is why baby traders consistently blow accounts. Now, chance, he does not open a trade and then start praying. He does not open a trade and then start thinking that, oh, maybe what will Bitcoin do? What will FMC do? FMC do? Yes. What will CPI do today, what will gold do today, what will all these things do. He doesn't leave himself to chance. He calculates his risk, his acceptable loss, and then he plays his game, go about his business, come back, take profit, then enjoy his day. He doesn't leave himself to chances. Now he shows and practices self-awareness. This is where most traders get it very wrong. You've had series of losses. Don't you think it's time for you to actually pack up for the day, possibly pack up for the week? Do you think prevent trading is what will get you back the money you've lost? For this trader or investor who have come to the place that he's adequately managing his risk, he knows that the greatest enemy he has is himself. He's very self-aware that, oh, I've had a loss today. I think I should call it a day. He's very self-aware that, oh, what I'm thinking to do now is actually revenge trading. He's very self-aware to know that, oh, if I do this, I can blow my account. I've not set my stop loss. What am I trying to do? He's very self-aware to know that, okay, let me step out. I must not trade today. This is who this trader is. This is who, and this person is not a baby trader. This person is a pro trader because he doesn't jump into trades. He doesn't have the fear of missing out for more. He doesn't feel like if he doesn't trade today, he will not make money. He doesn't feel like, oh, it's an addiction to trade. He can't stay away from the charts. He practices self-awareness. Then his patience. Remember, there are times in the markets where you get into a consolidation zone, that is, the market is either accumulating or distributing. What do you do at such times? You stay out of the market because the market is not moving. If you open a position at that point in time, you can start accumulating so much fee that at the end of the day, the fee you will pay for processing that trade may not be worth the profit you actually make from that trade. So for this pro trader who is adequately managing the risk, he knows that at this point in time in the market, he needs to stay out. He needs to wait. He needs to be patient to see his opportunity. Then if he eventually opens a trade, is he the one that closes his trade before the trade plays out? Is he that impatient because already he's afraid that, oh, he may lose each trade like he lost the other one, and then he cuts his wins and then he leaves his losses to run? Is he that kind of trader? Remember, this guy is someone that is patient. He waits for his setups to play out, either TP or stop loss. So the next thing we are looking at is every trade is a loss. This is one of the sayings that kind of cause so much trouble in the market. Every trade is a loss. Now the question is this: you may want to ask, or you may be asking yourself, and you're asking me as well. If every trade is a loss, then why trade? Do you get that? If every trade is a loss, why trade? Basically, most of us, which I believe everyone trades in the market to make money, no doubt, right? And then if every single trade is a loss in the market, why do we still trade? Now, to get the wisdom being shared by this very saying, now, when you want to open a position, it's okay and it's in your comfort to have the perception or to adopt the mindset that you've lost this money. This will do one thing for you. One, if the account or your part of your portfolio that you are risking, you're not comfortable with, have lost this money, then you should not take that trade, or you should not reach that amount. That is the first thing it does for you. And if you eventually open the trade, it will help you to manage the trade properly, to see the trade to win or losses. There are those times in the market, I don't know if you've seen it, there are those times in the market where you open the trade, maybe you bought at a support level here, right? Is a support level here, and the market is dropping, and then maybe you bought somewhere here, and then you have your stop loss somewhere here, right? And because you are not managing your trade properly, the trade starts going to draw down. Going when the trade gets here, you're not confident in yourself again. You're not comfortable with losing the money. You reached more than you can actually bear to lose. Oh, you now come and close the trade here. And immediately you close the trade, immediately you close the trade, you now started seeing this happen. And then you will now start mourning and now start feeling so sad. Why is the market against me? What is happening? It's because you did not answer this question. If every trade is a loss, why trade? You trade only when you are comfortable risking a given portion of your portfolio. You trade only when you are comfortable that, okay, I can risk this money. And you trade only when you know that the payoff from this trade will earn you so much that at the end of the day, you will be comfortable with what you are risking and what you'll be earning in return. Okay, so that's that about answering this question. If every trade is a loss, why do you trade or how will you trade? Okay, and this is a very strong risk management framework that you should adopt in the market. Now, avoiding rock bottom. Have you blown account before? This is something almost every trader does, just like almost everybody falls down from trying to learn to ride the bicycle, right? And then you may injure or you may not injure, but oftentimes we fall. So this particular subtopic of this risk management is aiming to help us avoid rock bottom. Rock bottom simply means not to blow account, not to borrow money and then get into debt, not to experience margin call or liquidation, not to blow accounts again. So the question that I want to ask you is this: honestly answer it. Have you blown an account before? If yes, how did you feel? For me, when I did that before, I think the last time was somewhere around 2021 or so. That was the last time I blew an account. And when that happened, it was so much money that I lost then. I felt so bad. I lost confidence in myself. I felt like, why did this happen? Like, I think I will say it pains more than heartbreak. when your girlfriend leaves you, you know, because the money lost then was so much money that couldn't bear it. I couldn't bear the thought of losing that kind of money, you know. And I think that's same for most traders. No matter how big or small you think the money is, if you blow your account, that account that you've worked so hard to grow, yeah, it breaks you, right? It breaks you. It's just like it feels so bad that it feels like the loss of a loved one. If you've not had that experience, employ adequate risk management to ensure you never have that experience. So that's that about when I blew my own account. And if you've blown your own accounts, kindly do share with me how the experience was and how you managed to come out of the situation. Now, question is, when was your last margin call? I can't remember the last time I had a margin call because I always apply risk management, right? I always set stop losses and I always calculate my position size adequately. So there's no need for me being margin called. Then for you who is listening to me in this video, do you want to blow your account again? If no, then start employing adequate risk management strategy. If yes, then keep doing what you are doing. I hope it gets you the results you actually aspire to get. Okay, so that's that about avoiding rock bottom. Do not allow yourself to come to that particular place that you've actually gone out of before. It's so sad. It's not comfortable. It's a place where you can lose yourself. You can become so angry. Some people commit suicide from it. But these are things that are avoidable, right? Because if you manage your risk, there's no need for you to actually get to rock bottom and start contemplating suicide or all those kind of negative thoughts. And the next thing we have on the slide is the best risk management strategy. My best risk management strategy is personality, yeah, risk reward ratio, and win rate. When you understand your personality, when we talk about personality, when I speak about personality here, I'm not talking about introvert, extrovert. I'm talking about the personality or orientation towards risking money. Some people are naturally risk averse. There are those people that feel like they are brave and courageous. They are audacious. So they want to do daring things. You understand? They always want to do things like counter trading the trend. They want to start the movement. Okay, they just like, okay, you're seeing the market is pumping. You feel like, oh, the market should sell. You don't have any reason, but then your gut feeling is telling that the market should sell. So because you just go into the market, maybe sometimes it has worked for you, and you think it will always work for you. At that point in time, it's not really a case of maybe your analysis, it's a case of your personality. You understand? You are doing something because you are somebody that you are very comfortable with taking risks. You know it's risky and then you want to do it. That's what makes you feel special. That's what makes you comfortable. That's where you draw your strength or your inspiration from. And then if you're a risk averse trader, someone that don't like losses, right? These are the things you need to consider: your risk appetite, your risk, your orientation towards risk. Are you a risk averse trader? Are you a risk loving trader? And when you understand yourself, you will tweak your risk management to suit your trading strategy, or you will tweak your trading strategy to suit your risk management, your risk appetite, your personality. Because at the end of the day, remember, trading is not about the chart, it's not about the data, it's about you. Because both of us can actually be looking at the same charts, can be looking at the same data, and will arrive at different consideration or different conclusions rather. And that is the makeup of the trader. That is the subjectivity of the trader. That is the person's personality. That is the trader's makeup. Your personality, your orientation. Are you risk averse? Are you a risk loving trader? Who are you? That is what these are some of the things that actually influence the decisions you make towards the market. Then risk reward ratio. When you talk about risk reward ratio, is a very straightforward something. How much are you making for every $1 you trade? For me, for every $1 I risk in the market, I aim to earn $3. That is my risk reward ratio. Anything less than that, I'm not interested in that trade. Right? What does it help me to do? It helps me to do. I could take two losses. But once I win a trade, just one trade that I win, right? I have recovered my losses. That is what a good risk reward ratio will do for you. Then your win rate. Your win rate comes from knowing how often you win. So you need to journal your trades. You don't just open trade and then you forget about it. Remember, this is your business, especially if you are actually an active trader, someone who trades more like full time or most of the time. You need to know your win rate. Your win rate, your risk reward ratio are things that you can actually use to predict your profitability. at the end of the day. So your win rate is getting by the number of wins you have over the total number of trades you've taken, maybe over a week, over a month, but make sure you do it often and often. That's your win rate. So these are the best risk management. If you put this into practice, you consider your personality, risk reward ratio, and then your win rates. These are the time you actually become a very successful trader and if someone who manages risk adequately. Now, your risk reward ratio and your win rate are not things you can actually get by just maybe looking at the market. These are the things you will get from back testing, from demo trading, and documenting is actually an adult work. So you do this, you document, and then you calculate objectively and honestly. Then at the end of doing this calculation and analysis, you use this to actually start modeling and start working towards being a successful trader. Now, these are the important risk management formulas that I want to share with you. Now we look at the risk of ruin formula. Yeah. So the risk of ruin formula, it calculates the probability of losing your entire trading capital. You get it considers the percentage of wins and losses and your risk reward. This is the WRS stands for win rate, which you calculate as a result of your win over your total number of trades. Your loss rate is the L, your loss over total number of trades, and then you input that into this formula, your number of trades. It tells you that particular probability if you can actually blow your account again or you are on the path to profitability. This is what this formula does for you. Then this expectancy formula, it tells you in a simple implementation what you should be expecting from every single trade you take. Is your trade profitable? Is your trading strategy profitable? This is your risk reward ratio, your loss, your win rate. This is what it takes into consideration. Now it tells you if you risk $1, how much are you gonna make? Do you get? But then if you don't want to go through this very formula, it's not really that necessary. What you should just do, okay, every trade I take should be this number of payoff or risk reward ratio. If I'm risking $10, definitely I should make $9. Sorry, if I'm risking $10, definitely you should make $30, at least $20. And when you do $20, $10 to get $20, it's more like two, one, 2 to 1 risk reward ratio. That's 1 to 1 risk reward, 1 to 2 risk reward ratio. Your risk is 1, your reward is 2. That's basically what that is. Then you do RR3, your risk is 3, 1, and then your reward is 3. That is 1 to 3. The RR risk reward ratio of 1 to 3. Risk is 1, reward is 3. That is when you are doing RR3. Okay, so that's that about these formulas. You need to implement that. If you do this adequately, I believe you me, blowing account is far from you. Then the last information I wish to share with you is this: the tips of how I implement this formula. Okay, I've given you some. How I implement adequate risk management is that for every single trade I take, I'm risking $10 per C. I'm supposed to win $30. If I project that that trade will not give me $30, I will not take that trade. Two, I'm patient. I don't take every single trade. I have special trades that I take, have setups, patterns, or signals that I want to trade. And I don't trade every single market. You understand? I also understand that I don't have to have a position open all the time. At the time I'm recording this video, I don't even have a trade running. Okay. So what's the reason? Because I've not seen any opportunity that I want to take. So that's how it is. That is how I implement these formulas. I understand the kind of person that I am. I used to be a very risk averse trader. Yeah. But then I worked on myself, become E. So I used to be a very risk loving trader. I'm always jumping into the market then at the early days. So after I took my time to study all this stuff and then I started implementing it, then I became a risk averse trader. I don't trade anyhow anymore. I work so hard to preserve my capital, and that you should do as well. If you do this, blowing account will stay far from you, losing money will stay far from you, and then your account, you see your accounts grow consistently. Now, how do you implement this formula? This is a question you should be asking. Then, how to implement this formula is one, I've shared some already. Backtest, demo trade, documents objectively. Now, get your win rates, A very high win rate means that you can comfortably do any of these things. You can comfortably have a low risk reward ratio, but it's not advised. Please, it's not advised. Try as much as possible to always use at least 1 to 2 risk reward ratio. 1 to 2. You are risking $1, you're supposed to make $2. That is how to implement this. Then always use stop loss. Always use stop loss. It's your stop loss that is your risk. It's not your account size that is your risk. Say for instance, you have your PIP calculator, you have your position calculator. And when you use a position calculator, it should be able to tell you that what you are calculating is not the money you should risk. Now, your position size can be bigger than your stop loss. You get? Because from experience, I may have a position size of let's say $100, and at that position size, my risk may be $20 or $25 or $10, depending on the trade, the way the trade setup plays out, and the amount of risk that the trade has. Now, it is between my entry and my stop loss that defines my risk and not my position size. But I've seen most traders don't know how to do this. They risk their position, which oftentimes, if you're having a position of $500, you get that's so much money that you lose on a single trade. So learn to calculate your stop losses adequately, and less is more. You don't have to be in the market all the time to make money. Forget about that. TradingView, all these exchanges, they want you to be in the market all the time, because you being in the market all the time is what makes them money. For each trade you open, remember, they are making money from the fees they charge you. When you close the trade, they're making money. So they want you to be in the market all the time. I don't know if you understand. Yet, you don't have to be in the market all the time, because your trades, your rare opportunities, they don't exist all the time. And for that particular reason, you are not meant to be in the market all the time. You need to become comfortable staying away from the market, waiting for your setup to play out, waiting for the daily candle to close, waiting for the 4 hour candle to close, waiting for the weekly candle to close, waiting for the monthly candle to close, waiting for us to come back from holidays like we're on holiday now. Okay. So these are all I have for you on risk management. Key takeaway: try as much as possible to implement this. And the more resources you should actually look out for, try to see Trading the Zone video by Mark Douglas, YouTube. Look at that. You may pick up the book and read if you can. But watch the video. I think that should be easier. Take some notes, study yourself, reflect on the trades you've taken before. Then if you have questions, send them across to me. Thanks for watching and thanks for attending this masterclass.